Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel, zinc and tin.
LME 3-month nickel. 9 weeks ago, I lodged the idea of there being a large bump and run reversal pattern stretching from July last year until May this year, in both your own and my mind. This was a transformation from an earlier descending scallop pattern formed over the same period. I asked you to bear this in mind, just in case for future use, as it was a pretty large pattern. However, this large pattern has since morphed again back into a descending scallop pattern, especially in recent days. Looking closer at more recent action, we had originally an early February to late March bullish Andrews pitchfork that showed the bullish angle of attack of the market, until the middle of May when the market breached the upper time. The breach was repaired, but in doing so, the prices swung around 180 degrees and headed lower, pushing down through the lower tine 7 weeks ago, carrying on down within a steep bear channel to the start of April, when prices hit the June 2021 low at 17,095. I said 5 weeks ago, and I quote, "This bear channel would dictate the market for the immediate future until it is broken or until the bear channel morphs into something else," end of quote. 4 weeks ago, the morphs into something else happened when the market sidled sideways out of the bear channel, and in the process formed a potential bearish halfway hesitation that last week became a reality. Now, if we look at the formation of the V-top with a pipe top aspect formed over May and the subsequent moves lower, we can see the whole V-top action from even February to date is not just a simple V-top, but a V-top with an extension. In these types of V-tops after the peak, the market may start moving lower, but then form a hesitation or congestion of sorts until usually a pennant or a bear flag type forms on the way lower. This hesitation happened here over late June until early middle of July and could be regarded, as I said 4 weeks ago, and I quote, "a hiccup in the road lower." And with this in mind, another factor to consider is that if we do see prices move down into the 17,100 to 15,845 zone, then the big pattern idea, the one of a descending scallop pattern morphing into a bump and run reversal pattern with some large upside potential, that idea may be morphing further back into a descending scallop pattern, but with some significant bearish potentials. Watch this space, end of quote. This is where we are now, moving lower, corralled, unlike other metal markets, not by a bearish Andrews or shift pitchfork, but by a simple late May to date downtrend currently at 16,340. This downtrend is the one to watch on any sudden strikes higher. Meanwhile, on the downside, we have the very significant lows of late November 2023 and January 2024 in the 15,840 zone to watch on the downside, which are not too far away. However, if we were to properly look at the action since late May to date as a big bearish halfway hesitation, then we would have to look down to the 13,750 zone, which is quite a way away. It is at this point I feel obliged to mention once again the big descending scallop pattern and what it may mean within the near-term universe. So the key levels already mentioned are the lows at 15,840. A significant move below this, and by that I mean that you would know it when you see it, a significant move below would give a potential for the descending scallop pattern on the downside down in the 13,830 zone, which is not too far from the potential below for the bearish halfway hesitation. Thus, it all comes down to what the market does once it reaches the 15,840 zone, should it get down that far. LME 3-month zinc. The mid-April to end of May purple highlighted ascending wedge pattern had driven this market higher up as far as the neckline of the September to December 2022 reverse head and shoulders pattern, where it peaked with a horn top in late May. This actually turned out to be a false break higher as prices moved back down, rejected by the neckline. The market subsequently reached the primary and secondary targets for the horn top, but the decline became more hesitant in mid-June, especially when it reached down to the interesting support, currently at 27.95, of the broken upper tine, highlighted in dark blue, of the old May to August 2023 bullish shift pitchfork that acted back then as an August 2023 to April 2024 upper bull channel line. I said 6 weeks ago, and I quote, "This is the first decent support we have seen, though I would not be surprised if prices do move further down near the middle time, currently at 26.31. That is between the medium moving average, currently 28.06, and the long moving average, currently 26.47. End of quote. It's not actually there anymore, but that's worth mentioning. Going back to my commentary, my initial reasoning for this was early June-based bear channel, and as I said at the time, and I quote, "This bear channel is running in the market at this time, and until it breaks or morphs into another pattern, it will continue to do so." End of quote. Well, 6 weeks ago, prices broke out of this bear channel, or rather prices wandered out the bear channel and stood around just like cattle that had broken out of a field and now look dumbfounded. In the end, prices rose in late June, peaking in early July, just over the big old 50% Fibonacci line for the 2008 to 2022 move at 29.65. I said 5 weeks ago about this move higher, that, and I quote, "But we can look as also a possible form of a halfway hesitation in a potentially much larger move lower. We will have to see how this develops, and I'm sure it will have caused a move, or at least caused another change into morphing into another pattern by then." End of quote. Since then, the market has undergone a number of changes, turning lower and becoming a bearish halfway hesitation pattern. I've chosen not to label it as such because it's such an ugly looking pattern, though I will say it is down in the 26.30 zone that we're looking for, so not too far away. However, all this has given me the opportunity to draw a new late May to early July bearish shift pitchfork, highlighted in bright red on my daily chart. For the moment, this is the pattern showing the driving bearish angle of attack of the market. Though I have to admit, this is quite a wide pattern. Right now, prices are between the overhead upper time, currently at 28.62, and the middle time below, currently at 25.89. Yet this is not the only feature to watch, as the market has today finally reached target X1 at 21.07, the secondary and much harder to reach target for the original purple ascending wedge pattern. Additionally, late last week, prices broke down through the previously outlined dark blue upper tine and have stabilized and headed lower this week. So what have we in the way below? We are currently in a fairly free area, but the obvious initial levels to look to below are the now flatlining gold highlighted long moving average and the old dark blue highlighted middle time, currently 26.31, as well as the March 2021 low at 26.27. However, the support at 26.01 is perhaps more interesting, as this is the gateway to all the congestion we saw last year that stretches down to at least the 23.97 level. Finally, to top all of this off, this market is set now for a week and a bit to go to have July become a monthly key reversal. Thus, if we close on Wednesday, the 31st of July, either over 29.85 or under 29.41, then we're beyond. Right now, we are most definitely looking at July as being a monthly key reversal down. LME 3-month tin. I said 9 weeks ago, and I quote, "It looks like the slim head and shoulders pattern formed over April is not a topping action, but possibly a continuation pattern, and maybe even be morphing into something else." End of quote. Well, that morphing into something else was what happened, with prices reaching up, creating over most of the month of May a more rounded action than the one seen in April, such that we had an April to May double top, Adam and Eve type. However, despite this pattern, the market was not finished with its creation of patterns, with prices attempting to drop down through the 50% Fibonacci line of the March 2020 to March 22 move at 31.845, as well as the neckline. However, all these supports together caused a reversion back up. But by the middle of the second week of July, this reversion had also failed, and prices dropped down back to where we have previously been. This failure to try for targets below for the small, narrow head and shoulders top, and then the double top pattern, Adam and Eve type, eventually led to another pattern, an April to July triple top. It also showed up the April to July sideways triangle highlighted in purple on my daily chart, which had a false break on the top side but a proper break on the downside late last week. I said as much 4 weeks ago, and I quote, "As a result of all this, a new larger pattern emerged last week," so that's now 5 weeks ago. A late April to date sideways triangle highlighted in purple on my daily chart. This pattern is much like the double top, still not complete, having only 2 touches per side, but it has potential, so I could see it working together with the double top idea, or maybe not working with it and making something else. Either way, keep a close eye on the purple lower uptrend. That's currently at 32,160, as it could also be seen as a neckline for the whole double top idea. End of quote. Thus, if we were to follow on with these ideas, we would see a primary target on the downside for the purple sideways triangle in the 29,970 zone, a target already achieved, and a secondary harder to reach target X down in the 26,260 zone. Meanwhile, the triple top idea would see a primary target down in the 30,100 zone, and that's a target already achieved, and a secondary harder to reach target X1 down in the 28,070 zone. Now, what we have in the way is the congestion between 28,835 to 29,005, which we're testing right now. That contains the July 2011 high at 29,005, not really a very recent piece of pedigree, plus the slowly rising gold highlighted long moving average, currently 28,340, and the neckline extension of the October 2023 to January 24 reverse head and shoulders bottom, currently at 27,595. And finally, the 50% Fibonacci line of the March 23 to April 24 move at 27,330. Now, to be honest, I'm not sure which of these is best, but the lower prices go, the greater will be the support. I'll only finally add that I have drawn in mid-April to mid-July a bearish Andrews pitch hook, just as an in-case scenario. The market is just below the middle time right now, currently at 29,630, and I'm quite prepared to move the bearish Andrews pitch hook into a shallower bearish shift pitch hook, or retire it completely. My final point is that with a week and a bit to go, we are set up to make July potentially a monthly key reversal. This will be closed on Wednesday the 31st, either over 32,820 or below 32,610. We'd be on. Right now we are most definitely looking at a monthly key reversal down.